How much has been priced in at this point into the bond markets? How much more is there to go?
Well, you can see in the US above 3%
Yeah.
is now in the yields, and it's in the forwards.
Is that the floor now, do you think?
Well, I think the floor is important because it keeps going up. And so for me, trying to put a forecast around all of this, the floor for yields is higher. And it makes it untenable to expect yields to be lower anytime soon, because it's impossible to imagine yields falling whilst the central bank's hiking in the early stages. So we need to be somewhere towards the second half of the tightening phase, and we're very much in the first half. So that puts the floor under yields. I think that's quite right. But I've thought of this as a game of two halves. We're still in the first half. In fact, if it was a game of football, we've only played 30 minutes, right? So we're still in the first half. Central banks might be hawkish now, but they could easily become dovish in the second half. So things could change.
So when's the second half? Early 2023 when this plays out, or are you talking about an end to the war in Ukraine?
We're talking about the Fed being at 2% by July. So that's 250s, right? The Bank of England could be 6 months in front of the Fed, so maybe there's a read across there. So it looks like the midpoint, and then there's Jackson Hole coming in August. There's a chance for some kind of set piece. So the data is already softening, and I imagine that the market's going to look completely different in the second half as economists revise down their growth numbers, and presumably inflation is coming off. I'm frightened to say that too loudly because we've been stung by this already. We're all waiting for inflation to fall. The danger is it doesn't. But I think that there's a very strong base effect, and we should expect a few lower prints coming up.
Stephen, what's the intersection between rate hikes and quantitative tightening?
Well, I don't think QT matters so much to government bonds if it's of the passive variety. The active variety, whereby the central bank actually sells bonds into the street, we're going to find out, and the Bank of England is going to start the consultation on this. But presumably markets move in advance of the news, and so it should be largely absorbed. I think it's more important for risky assets, and we've already seen how equities have been hit by a tightening of financial conditions. Maybe the war in Ukraine is one of those drivers, but it could also be the fear of QT, because it is true that equities went up from March 2020 onwards during the massive QE. So if we move into the reverse, it could be that risk assets still have to reprice.
So, Steve, what would you buy in Treasuries right now, if anything?
Well, if I spoke to my colleagues, they'd say don't touch anything. And most of my colleagues are very worried about the momentum. And I think that investors don't want to try and catch a falling knife. I think the longer end, the 30-year, is now starting to find some kind of bite. And when you see yields above 3%, it becomes compelling for the longer-term investors who are going to switch from equities. So think about the pension funds and insurance companies, etc.
Japanese investors, are they going to come back in at this point?
Yeah, well, everyone uses that one. On the assumption that yen rates stay where they are, then that's a reasonable idea. And from a currency perspective, don't forget, any Japanese-based investor who bought dollars has done very well on the currency side. That will at least have offset the loss on the bonds. But I think globally is the right way to think on this, because the Fed and the Bank of England are not acting in isolation. What's happening in China? There's a weaker outlook there. How far can rates go in Europe? And so the global picture, I think, is relatively benign for rates, and I don't think the US can break away from that so much.